James, thanks for joining. Welcome to Bloomberg TV. So starting with your trading figures, FIC coming in really strong, 15%. It's another quarter of defying expectations and beating Wall Street. Should we be viewing this as the new normal at Deutsche Bank?
Well, look, we've been working hard to build sustainable revenues and sustainable profitability over the past several years. And the performance in FIC this year, as you say, 15% up year on year, comes against actually quite a strong first quarter last year. What we're seeing is increasing client engagement, I think a focused approach to the business, the benefits of technology and people investments over the past several years, and also, frankly, success in risk management that has been an area we've prided ourselves on for years. Obviously, in a very volatile quarter, it was a key part of the performance.
Well, given that, will you be upgrading your outlook for the full year?
We're sticking with the revenue outlook for the full year that we provided back in March of 26 to 27 billion euros. That's growth on last year and well ahead of where the market consensus is. And it reflects, frankly, solid performance and momentum in all four of our core businesses. We talked about the investment bank or FIC business within that, but we had 11% growth this quarter year on year in our corporate bank, 7% in the asset management business, and 2% in our private bank, which, as you know, is still feeling the effects of interest rate headwinds. So with all of that, both top line and underlying growth, we're absolutely seeing the momentum in those businesses that we've been calling for.
Overall strength, again, in the investment bank, but perhaps one flying the ointment is origination and advisory, which fell. Are you seeing concern among clients or perhaps even fear that reflects that decline?
Well, look, I think it's two things. One, the normalization of business volumes that all of us expected after very strong years in 20 and 21, influenced, of course, by the reaction to the pandemic. But on top of that, of course, the environment, the uncertainties, and the horrible events we saw begin and to unfold in the first quarter, they naturally affected business confidence, confidence in boardrooms, and the volatile capital markets environment naturally affected issuance volumes. We think that trend will continue somewhat into Q2, but with more stability and confidence, we would imagine levels will pick up from here over time.
What, in your view, is the biggest threat when it comes to this geopolitical uncertainty?
Look, the interesting thing, the war in Ukraine naturally dominates our thinking because it's on the news every night, and we're all horrified by the pictures that we see. But for the economy, there are other effects out there. Of course, the supply chain disruptions, the lingering effects of COVID, including lockdowns in China, and naturally high energy prices that actually existed prior to the war effects. All of those, I think, are having an impact on the economy and business confidence. And we also stand in front of what will be a relatively historic rate rise cycle that's beginning in the United States. People are calling for it now here in Europe as well, and that adds to the uncertainty. In all of that, we'll need to travel through that uncertainty. The future is obviously, and the business performance is scenario dependent, but those worries are present in the markets, no question. Well,
to be fair, James, your economists perhaps are more pessimistic than most when it comes to the future scenarios, be it a recession in the U.S. and now in Europe, Russia announcing that they will no longer be servicing gas to Poland and Bulgaria. So perhaps for Europe, the worst case scenario might be coming true when it comes to high energy prices. What impact would this have on Deutsche Bank?
Well, look, as you say, our economists have been on the, regrettably, the leading edge of considering inflation to be more persistent, arguing that the central bank actions would need to go beyond what markets' expectations were to really impact inflation as they would like to. And of course, they made a recession call a while back and sort of re-emphasized that with some work they published yesterday. Look, for the European economy, there's no question that that's an overhang. The price and sufficiency of energy into the European economy is something that has come under question. There are efforts underway, as you know, to find other sources. We need to refactor the economy and our industrial base in some senses around the energy supplies that we have and, of course, the transition to a green economy. So there is that uncertainty. I think the events yesterday essentially crystallize that uncertainty to some degree. And we'll see what the future holds now in terms of continued gas supplies to Europe.
How much of that is reflected in your higher credit provisions, 292 million euros? Is that a worst case scenario there?
Look, it's early days so far. We incremented the provision quite considerably. More than half of the nearly 300 million that we provided this quarter was influenced by the war in Ukraine and those events. The underlying credit environment and performance is actually very strong. And so you have these two factors at work. As we stand here today, we don't see yet the larger impact in terms of credit of the events, the war in Ukraine and the knock-on impacts. It's too early to say, but we're encouraged so far by the second-order impacts. As you say, around energy prices, energy sufficiency, the risks are still there. There are naturally some downside scenarios to GDP growth. Right now, that's not the base case, and hence, we have a relatively high degree of confidence in our current outlook on credit provisions.